Hey everyone, welcome back to Corporate Decoder. Today, 22nd Century Group Incorporated XXII just filed an 8K highlighting a potential $6.4 million stock sale, and I'm seeing something interesting about their market position. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is clearing the path for a significant stock offering something that could bring in much needed cash, but also dilute existing shareholders. May 1st, 2026 is the date on this report, and it signals an important event for 22nd Century Group Incorporated. They have filed a prospectus supplement, which basically means they are getting ready to sell more of their stock. This filing is all about keeping the Securities and Exchange Commission informed about what the company is up to. Specifically, they are talking about a sales agreement they have with Needham Company LLC, which is a financial firm. This agreement allows 22nd Century Group to sell shares of their common stock. The company 22nd Century Group Incorporated is planning to sell up to $6.4 million worth of its common stock. This is an at-the-market offering, meaning they can sell shares at prevailing market prices. It is important to note that as of the date of this filing, they had not sold any shares under this agreement in the prior 12 months. So the full $6.4 million is available to be sold. Looking at their stock, they have common stock with a very small par value of $0.0001. This is pretty standard for many companies. The ticker symbol for this is XXII, and it trades on the Nasdaq Capital Market. As of May 1st, 2026, the company had a significant number of shares outstanding, over 4.4 million shares. This offering could increase that number quite a bit. The core of this filing is about this material definitive agreement, essentially the sales agreement with their underwriter. When a company wants to raise capital by selling stock, they often use these types of agreements. It's a way to access the public markets for funding. They are essentially saying they have the green light to sell up to $6.4 million worth of their stock. Beyond the main event of the stock offering, the filing also lists some exhibits. These are supporting documents that provide more detail. We see an opinion from Foley and Lardner LLP, which is a law firm, and their consent. These are typical legal and administrative documents that accompany such filings. Now let's look at what this means for investors and the company. 22nd Century Group Incorporated is in the consumer defensive sector, specifically tobacco. Companies in this space often face regulatory scrutiny and changing consumer habits. The market cap is currently very small, around $2 million, and they have only 32 employees. This suggests a relatively small operation. Recent news headlines from around May 1st, 2026 show a mixed picture. One headline mentions they are clearing the path for this $6.4 million sale, which is positive in terms of accessing capital. However, another headline from Quiver Quantitative points out that the stock slid 12.6% as a rally faded and dilution risk remains in focus. This is a crucial point. When a company sells more shares, especially when it's a significant portion of its market cap, it can dilute the ownership stake of existing shareholders. If you own 100 shares in a company and they issue 100 new shares, your 100 shares now represent a smaller percentage of the company. Think about it this way. If you and your friend own a pizza and you decide to add 2 more slices to share with 2 new people, your original slice becomes a smaller piece of the whole pizza. That is dilution for 22nd Century Group Incorporated. With a market cap of only $2 million, a $6.4 million stock sale is a massive event. It could potentially triple the number of shares outstanding if they sell the maximum amount, leading to significant dilution. This type of equity raise, especially when the company's market cap is so small, is often a sign of needing cash to fund operations or growth initiatives. It is also why analysts are pointing to dilution risk. When we see a company with a small market cap and a small employee base, often these offerings are to keep the lights on for a bit longer or to fund extremely speculative projects. We can see that they have some institutional holders like Anson Funds Management with a notable 4.6% stake. But others like Vanguard and Geode Capital have very small percentages. This indicates that while some funds are invested, the majority ownership is likely still with retail investors or insiders. The company's strategy here is to raise capital. Given their market and employee numbers, it is likely they are aiming to either scale up operations, invest in new product development, or perhaps cover short-term financial needs. However, the immediate impact for existing shareholders will be a reduction in their ownership percentage, and potentially a drop in share price if the market perceives the dilution negatively. Looking at the broader context for 22nd Century Group Incorporated, they operate in the tobacco industry. This industry is known for its strong cash flows, but also faces significant headwinds from changing regulations and health trends. Companies in this space often rely on brand loyalty and innovation to stay competitive. What I'm looking at here is the balance between the need for capital and the impact of dilution. A $6.4 million offering on a $2 million market cap is a very significant dilution event. Companies that undertake such large offerings often see their stock price pressured downwards. If they were in a strong growth phase with clear avenues for that capital to generate substantial returns, it might be viewed more positively. But for a company with their current size and employee count, it raises questions about the path to profitability and long-term value creation. Comparatively, think about other small companies that have had to do massive stock sales to stay afloat. Often this signals an uphill battle. For instance, when smaller companies engage in significant dilutive offerings. It historically has led to continued stock price declines as the market digests the increased share count and the ongoing need for capital. Without a clear and compelling plan for how this new capital will drive substantial growth and profitability that outweighs the dilution, existing shareholders could face significant paper losses. A $1,000 investment in a company that doubles its shares outstanding could theoretically see its value drop significantly if the company's overall market value doesn't double in lockstep with the share count, which is often the case. The risk I am watching is whether this capital infusion will be enough to turn the tide for 22nd Century Group Incorporated, or if it is merely a temporary fix that delays an inevitable struggle given the size of the dilution. My biggest concern is the sheer scale of the offering relative to the company's current size, which suggests a potential struggle for sustainable growth without further, more dilutive, capital raises down the line. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.